Leverage is one of the biggest components of real estate investing. The fact that you can buy and own an asset with only putting as little as 3.5 to 25% down is crazy. It's such a powerful tool that most investments don't allow you to use, but with real estate, the bank's going to help you out and let you have a loan for the rest of that money, and you're going to be the one that gets to reap the rewards with the cash flow and all the appreciation that you're going to get with owning the asset of real estate. Hi, and welcome to my channel. My name is Moynihan. I'm a real estate agent and investor based out of Keene, New Hampshire. And if you're someone around the area looking to buy, sell, or invest, feel free to reach on out and have any questions, just feel free to shoot them my way. I'd be more than happy to help and assist you. Even if you're just watching the video from out of state and you just kind of have some questions on real estate or maybe investing in general, just let me know. I'll see if I can be any help to you. And if at any point this video has enough value to deserve a like, I would greatly appreciate that. And also clicking that subscribe button, as I do release weekly real estate related videos. And if you want to kind of stay more up to date with what I do personally and on a daily basis, feel free to follow my Instagram. I post there every day and of course all the time on my story, so you can kind of stay a little bit more up to date what I do real estate investing and real estate agent wise. But without further ado, let's get into why leverage is so important in real estate investing and how it's such a crazy powerful tool. So how does this work? The word mortgage actually comes from the Latin origin of two words, mort, meaning death, and gage, meaning pledge. So it stands for death pledge, which doesn't sound very good. But of course, in this situation, your pledge is paid back once you pay back your mortgage or your debt that the bank allowed you to have. So a bank will give you, of course, what they call a mortgage, which I'm assuming most people know what it is or at least have heard of what it is. And a mortgage is an agreement between you and the lender that allows you to borrow money to purchase a property. And if you fail to repay that mortgage, then the lender gets to take that property back and they are the owner of it. The bank does this, of course, to make money themselves with the interest rate they charge, the loan origination fees, closing costs, and a multitude of other ways. Then again, if you don't keep up with the payments and defaults on the loan, that lender gets to have the property back and they're going to recapture the loss the best they can when they go to sell it on the other side. And there is a big difference between good debt versus bad debt, and I'm going to touch on that a little bit later in this video. Now for mortgages, the bank is going to look at you solely as an individual borrowing the money and determine what you can afford based off of your income, credit score, and your monthly debts. A big thing they look at is your DTI, which stands for the debt to income ratio. And this is simply as it sounds, what are your monthly debt obligations for payments and what is your monthly income that you actually receive? And then they base off what you can afford for a loan, basically with the difference of those two. Now, if you're a first-time home buyer, I always suggest to at least look into multifamily property because this would allow you to live in one of the units and rent out the remainder units to help as additional income, one, and two, to help cover your cost of your actual mortgage that you took out, allowing you to hopefully live for free or at least greatly reduce your cost of living. And in this situation, you can take advantage of using an FHA loan because you're a first-time home buyer, which allows as little as a 3.5% down payment. Or if you're just normally owner occupying and you're gonna go a conventional mortgage, you can get anywhere from usually 5 to 10% down owner occupy loan, which also is a great option to get into your first investment property. Now, if you're strictly looking as an investor, you're going to have to be coming up with a little bit more to the table for a down payment. Now, this is typically anywhere from 20 to 25% of the purchase price. And you can go conventional financing, which again is where they're looking at you and your finances solely based on how much you're allowed to borrow and going to look at how much you can afford. Now, there's also a really cool loan product called a DSCR loan, and this stands for debt service cover ratio. And this is actually where the bank is going to be looking at the property that you want to purchase and analyze what you can get for a loan and if it actually performs and cash flows. And the loan is going to be based off how the property performs. It's not going to look at any of your personal income, any of your credit score, any of that. All they really care about is if you have a 20 to 25% down payment and the property itself performs well. Now, one thing you don't want to do is over leverage yourself in real estate. This is where it can just become black hole because you can get way too far down in the hole and you can't get out of the debt. So the reason I say this is because say you went with a DSCR loan where they're not looking at your personal finances, but if you don't have 25% down payment in cash, you could always take out hard money loan or maybe a HELOC against your primary residence. A HELOC is a home equity line of credit, and you can use that as your 25% down payment for the DSCR loan property. Now, the only thing with that is you're 100% financed. You have no money in the deal, which is awesome because you didn't have to take anything out of your own pocket to put into the deal. But the problem with that is you're so leveraged, you have no equity built into your building. So if something arises and something goes wrong where you have to pull out a big chunk of money to pay for, say, a roof or heating or any of that, and you start falling behind, you might fall behind on your payments, skip a payment here or there, and actually end up defaulting where you're going to get foreclosed on the property, and it just becomes a black hole that you don't want to do that. So a lot of times you want to make sure you have some type of equity in your house. Leverage is super big tool that you can use in real estate. But again, you don't really want to become over leveraged just in case something happens. You want to make sure you have some type of equity built into that property, because for some reason, say you miss a few payments, you're like, crap, I need to sell this property and get out from under it. If you're 100% financed and you have no equity in the deal, chances are when you sell the property, you're not going to make any money because you have to pay for real estate agents, you have to pay for closing fees, you have to actually pay off the loan, pay off your HELOC. You've got a lot of stuff to pay off, and maybe you might end up in the red on that and end up owing even though you sold your property, which is not the key to investing in real estate. Now, as I said earlier, there is a difference between good debt and bad debt, and it's pretty easy to decipher between the two of them. Simply, does the debt that you have out make you money? If yes, wow, you did it. You got good debt. If no, like most people in America, then you probably have bad debt. Most consumer debt you have is bad debt. Credit cards, car loans. If you're just buying something to buy it maybe on a store credit like a Rent-A-Center, because guess what? You really want that new TV. You really want that new couch, but you don't have the cash for it. Well, that's bad debt. You don't have the cash for it, so don't buy it. It's that simple. And if you need it that bad, just figure out maybe a different way, or if you have to put it on it, make sure you have a plan to pay it off so you don't fall into that consumer debt hole that so many people do because they don't realize most credit cards are around 20 to 25% interest. And when you have a remaining balance on that, that adds up very quickly. And the stuff that you bought for that $200 pair of shoes that you really wanted, if you don't pay that off and you get an extra 25% onto that, that's an extra $50. Now that just cost you $250 to have that pair of shoes. Was that worth it? I would say no. Now, good debt, that is anything that is making you money. So that can be anything like buying rental properties where you actually take out a loan for it, or a business loan that you're trying to expand and actually grow your net worth and grow your wealth. That is considered good debt. So say you buy a duplex and you have a $2,000 a month mortgage on it, but that duplex brings in $3,000 worth of rent. You have $1,000 you're making because you have a loan on that property. So chances are you didn't have the cash on it, so you bought it with 25% down. But say you even did have the cash to buy that all out, and you could have just bought it straight up for cash. But the point of leverage and why it's so powerful, instead of buying one property all out in cash and reaping rewards on one property, you split that into little chunks. So you do a 25% down payment on maybe 3 properties so that you actually have loans out against 3 properties, but you're reaping the rewards because you have 3 different properties bringing you in way more income, and that is the power of leverage. So really, I just wanted to make this video to show the power of real estate and how leverage plays such a big part in that. Because if you're going any regular investment route like stocks, bonds, mutual funds, it's not like you can buy $100 worth of stock for $25 and be like, yeah, well, give me the rewards for $100 worth of stock. That's not how it works, but that's how it does work in real estate. So you can take out a $300,000 loan with only a 20 or 25% down payment, and you get to own, operate, and get all the rewards from that piece of property, even though you only put 25% of your money into it. And then once you have your tenants in there, actually making it your investment property, your tenants are the one covering your mortgage, you get to get the money left over in the cash flow, which it should cash flow, and that's the reason you invest in real estate, and you get to reap the rewards. And then when you sell the appreciation, you're the one that benefits from that. So you just pay off what you owe for your mortgage, which is slowly going down and down and down with every mortgage payment you make. And again, tenants and other people are paying for that to go down. And then when you sell, you pay off that, and you get to keep the difference of the appreciation and actually getting the big payout at the end. So that's what I really wanted to cover in this video. I really hope that it kind of showed you what leverage is, how to use it, and why there is good debt versus bad debt, and which one you should have. Good debt, a little hint there. I hope it kind of added enough value that it does deserve a like from you. And again, hit that subscribe button, as I do post weekly real estate related content. If you have any questions or anything that you're like kind of pondering upon, just put it down in the comments, and it can always maybe become a future video, or maybe I'll make it into a reel. I'm always posting reels on my Instagram, so follow me there. I post pretty much daily, every day on my story, but pretty much daily, either feed posts or reels or something like that. Always trying to add value to you and help you get further along in your investing career, just like I am. And I'm just trying to document what I do and kind of share it with others, because I see how powerful it is. So with that all being said, my name again is Shane Moynihan, and I'm a real estate agent and investor based out of Keene. If you're looking to buy, sell, or invest, feel free to reach out to me. I'd be more than happy to help. But until next time, I'll catch you next week.